If you're watching the price of Bitcoin, you're looking at the wrong thing. For the next few minutes, we are not going to talk about price. We are not going to talk about bull markets or bear markets. Instead, we're going to ask a much more fundamental question. Who has control over your money? The daily news is a spectacle. Red arrows, green arrows, and expert debates designed to keep your eyes fixed on one number. But this is a distraction. It's a sleight of hand. While you're watching the price, the very rules of the financial game you've relied on are being rewritten. This isn't about getting rich. It's about understanding a quiet crisis of control that's unfolding. Because the most important question isn't, what's the price? It's, who gets to lock the doors? And we're going to uncover the one feature of any financial system that ultimately decides who holds the keys. Stay with me, because the answer may not be what you think. We all grew up with a simple promise. Put your money in a bank and it will be safe. But what does safe truly mean? The dollars, pounds, or euros in your account today are not a fixed store of value. They are instruments of policy, and that policy has a hidden cost. Central banks call it accommodative monetary policy. It's a sanitized term for creating more money from nothing. While this can stimulate the economy in the short term, its long-term effect is a slow, methodical erosion of your savings. This isn't a flaw in the system, it's a feature. It's a quiet tax that devalues the money you've already earned, forcing you to constantly outrun inflation just to stand still. But this slow decay is only half the story. The bigger risk isn't the leak in the boat, it's the structural integrity of the boat itself. The World Economic Forum's 2026 Global Risks Report warns of rising geoeconomic confrontation, a world where the foundations of global cooperation are fracturing. This isn't just political theory. These are direct threats to the plumbing of the global financial system, the pipes that carry your money. So while we are told our money is safe, the reality is that it's permissioned. It exists within a system that is quietly devaluing it by design and is showing signs of deep fragility under stress. But what happens when that fragile system is forced to choose between protecting you and protecting itself? What does it look like when your access to your own money is no longer guaranteed? We don't have to guess. We've already seen the blueprint. Think back to the GameStop event in 2021. A wave of retail investors used social media to coordinate buying a stock that Wall Street had bet against. For a moment, it was a story of the little guy winning. And then the game was turned off. Brokerage firms like Robinhood suddenly restricted users from buying certain stocks. You could sell into the panic, but you couldn't buy. The doors were locked. Why? Not because of a conspiracy, but because of the system's design. The clearinghouses, the invisible intermediaries of the market, demanded billions in collateral from the brokers to cover the risk. This is the critical point. The system wasn't broken. It was working exactly as intended. To manage stress, it didn't pause the game. It changed the rules mid-play to protect its largest institutional members. The individual investor was not the priority. System stability was. This is the difference between ownership and permission. It was the chilling discovery that your access to what you own is conditional. These are not isolated incidents. The system's plumbing is under constant strain. As recently as February 2026, the Financial Stability Board issued a report highlighting systemic vulnerabilities in repo markets, a core component of this plumbing, noting they can amplify financial shocks. The system's solution to these stresses isn't to become more resilient, but to build better circuit breakers. But who do those breakers protect? This reveals the core trade-off. In the traditional system, control is centralized. And in a crisis, that discretion will always be used to protect the center. So what would a system look like that has no center to protect? This brings us to why Bitcoin was created. Stop thinking of it as a speculative asset and start seeing it for what it is. A different kind of financial system, built on a different set of rules. Its rulebook was written in direct response to the failures of a system based on discretion and control. The first rule, a fixed supply. There will only ever be 21 million Bitcoin. No one can vote to create more, no matter the economic pressure. This makes it fundamentally resistant to the deliberate devaluation that plagues our savings. But the most important rule is this: there is no ruler. Bitcoin is decentralized. There is no central authority to freeze an account, halt a transaction, or change the rules when it becomes inconvenient. Your ownership is not a permission slip granted by a bank or broker. If you control your private keys, you have absolute sovereignty over your funds. This is called self-custody. It is the restoration of ownership in a world of permission. In an era of what the WEF calls geoeconomic confrontation, Bitcoin offers an alternative governed by mathematics and code, not by the shifting agendas of institutions. It's a system where the rules are the same for everyone, regardless of their size or influence. It's a lifeboat built on predictable rules in an ocean where the old ships are relying on discretionary patches. But what about the storms? What about the volatility? Now we must address the elephant in the room, the price swings. The headlines scream about volatility. Just in early February 2026, Bitcoin saw a significant drop before recovering. Critics point to this as proof of its riskiness. But here, we must flip our perspective entirely. In the traditional system, a crash signifies a failure that requires a bailout, a discretionary intervention. In Bitcoin, a price drop is a stress test that happens in the open, and the network passes it every time. These corrections are not a bug, they are a feature. They function like the network's immune system, purging excessive leverage and washing out short-term speculators. Every major price drop in 2018, 2022, or this month shakes out the gamblers and leaves the network in the hands of those who understand its fundamental purpose. This volatility is the price of admission for a global market that operates without a safety net, without a central bank to prop it up, and without bailouts. A price crash in Bitcoin doesn't threaten the system, it strengthens it. While the price fluctuates, the network's rules remain absolute. It has never been hacked. Its protocol has never been down. For over a decade, it has produced a new block of transactions approximately every 10 minutes, without interruption. The price is the story of human emotion. The network is the story of mathematical certainty. Which one do you think is more resilient? So, I'm asking you to make a different kind of investment. Not with your money, but with your time. Close the price charts. Mute the noise of daily predictions. Your financial sovereignty won't be secured by guessing a price direction correctly. It will be secured by understanding the system you are in. Start by reading the original 9-page Bitcoin white paper. Understand the problem it was designed to solve. Learn the meaning of decentralization, proof of work, and self-custody. Then, turn that lens back on the world around you and ask the hard questions. Do you truly own the money in your bank account? Who gets to change the rules of your financial life, and for whose benefit? In a moment of crisis, does the system you rely on prioritize you or itself? This is not about trading. This is about a paradigm shift. If you are ready to move past the noise of price and start building a framework for long-term financial resilience, you are in the right place. The number on the screen is a distraction. It's the ever-changing debate. The real signal is the steady, predictable rhythm of the Bitcoin network, operating outside the control of any single person, corporation, or state. Remember the question we asked at the beginning? What is the one feature of a financial system that determines who wins and who loses in a crisis? It isn't the price, it isn't the volatility. It is whether the rules can be changed. The panic over Bitcoin's price is a luxury for those who still have faith in the old system. The real crisis will be the day people realize their safe money is subject to someone else's discretion. The day they find the doors are locked. The story of this decade will not be about who bought low and sold high. It will be about who understood the difference between permission and ownership. Here's the mental model to carry with you. Price is a temporary consensus, but the protocol is a permanent contract. So I'll leave you with one final question to consider. In a world of increasing uncertainty, do you want your savings in a system governed by discretion or in a system governed by rules that no one can change?